Welcome back to Hedge and Haven, your go-to channel for turning market chaos into wealth. And today we're diving into a massive shakeup. Trump's 2025 tariffs are hammering the stock market, and it's a brutal scene out there. But here's the kicker. This crash could be your ticket to millions. In this video, I'll unpack why stocks are plunging, how to profit big when others are running scared, and the exact stocks I'm buying. Plus a smart diversification trick with just $10. Stick around. Let's hedge the havoc and build your haven of wealth. The stock market experienced a brutal downturn, with major losses triggered by President Trump's newly implemented tariffs, marking what could be the worst day for U.S. equity markets since the pandemic began. Despite the chaos, opportunities abound. Millionaires are often born during market crashes, especially when the drop is significant. The key is to seize the moment and invest boldly when others are gripped by fear, a strategy that can lead to substantial wealth without relying on luck. In this analysis, I'll break down the reasons behind the market's plunge due to these tariffs, predict how far stocks might fall and for how long, explain how to capitalize on others' panic, and highlight specific stocks I'm targeting as prices tumble. This is a rare chance to build wealth, so let's dive in. Global stock markets are reeling as Trump's tariffs take effect, with the S&P 500 and NASDAQ suffering their steepest decline since the pandemic, driven by unexpectedly high reciprocal tariffs imposed on nearly every country. For instance, goods from China now face a 34% tariff on top of an existing 20%. EU imports carry a 20% tariff, and Southeast Asian nations like Vietnam and Cambodia are hit with tariffs ranging from 46% to 49%. These regions, China, the EU, and Southeast Asia, supply a significant portion of U.S. imports, including textiles, machinery, and electronics. The tariffs are part of a broader economic strategy, inspired by Stephen Moran's paper on restructuring global trade, which I've studied to understand its implications. Moran, the White House Council of Economic Advisors chair, advocates using tariffs as leverage, enforcing fair trade through reciprocal measures, and restructuring U.S. foreign debt. However, I believe this plan may falter, influencing my investment choices, backed by data, not politics. The tariff strategy unfolds in three stages. First, tariffs pressure countries like Canada and Mexico, previously hit with 25% tariffs, to renegotiate trade deals, addressing trade deficits and border issues. Second, reciprocal tariffs aim to level the playing field. If a country imposes a 20% tariff on U.S. steel, the U.S. mirrors it, ideally pushing all nations to lower trade barriers. Third, the plan seeks to weaken the U.S. dollar to boost exports and labor competitiveness without jeopardizing its reserve currency status. Yet the market's crash stems from tariffs exceeding expectations. Rather than mirroring foreign rates, they're calculated using a formula tied to trade deficits, dividing the U.S. deficit with a country by its exports to the U.S., then halving the result. For example, with China's $295.4 billion deficit and $439 billion in exports, the tariff lands at 34%. Inconsistencies abound. The UK, despite a $12 billion U.S. trade surplus, faces a 10% tariff, as do 115 other surplus nations. This disconnect suggests these tariffs aren't truly reciprocal, making them unsustainable as retaliatory measures, like China's new 34% tariff on U.S. goods, emerge. Given their shaky foundation, I doubt these tariffs will endure, meaning the current pressure on stocks could reverse. Historical data offers clues on timing. Bull markets average 4.3 years with 150% returns, while bear markets last 11 months, dropping 32% on average. Declines take about 13 months to bottom, with 24 months to recover, plenty of time to strategize and buy low. The CNN Fear and Greed Index, currently at extreme fear, guides my timing using indicators like market momentum, S&P 500 versus its 6-month average, and the VIX Volatility Index. I'm holding cash until momentum shifts upward and volatility stabilizes post-spike. As for stocks, I favor the NASDAQ 100 for its amplified swings and target consumer-sensitive companies like Google 43% undervalued, 77% upside, Meta 43% undervalued, 75% upside. TSMC 50% upside amid chip tariff threats. And Nvidia 20% plus upside. Diversifying into real estate via Fundrise's flagship fund with a $10 entry also hedges against market turbulence. Data, not instinct, drives these picks. Millionaires are made by buying smart in a crash. That's it for today's deep dive, Hedge and Haven fam. Trump's tariffs may be rocking the market, but with the right moves, you can turn this crash into a goldmine. Google, Meta, TSMC, Nvidia, and a sprinkle of Fundrise real estate. My playbook's set. What's yours? Drop your thoughts in the comments, smash that like button if this helped, and subscribe for more strategies to thrive in any market. Until next time, keep hedging the risks and building your haven. See you soon.